Welcome to Excel and Finance video number 11. Hey, if you want to download this workbook and follow along, click on the link directly below the video and you can download the workbook Business 233 Chapter 2. Hey, we have been talking about the balance sheet and the income statement, and now we need to talk about cash flows. Now I'm going to uncharacteristically go over to a PowerPoint presentation, cash flow identities. Here's the problem with accounting and finance. Most of the information from corporations comes from inside of the corporation to the outside in the form of financial statements. Now, accountants create these, and accountants use accrual accounting. We talked about that in past videos. Accrual accounting does not consider cash flow. They're concerned with, on the income statement, whether revenues are when they're recorded when they're earned, and expenses are recorded when they're incurred. Similarly, on the balance sheet, we have accrual accounting affecting, for example, net fixed assets. So if all of that is true, accountants create this accounting information, which is great information, but financial managers are interested in cash, not accounting numbers. So we have to take our information given to us, financial statements, and convert it into cash. Now, here's the fundamental accounting equation. Assets equal debt plus equity, or liabilities plus equity. All right, I just use the word debt because it's 4 letters, and even better than the word liability, expresses exactly what this is. We owe. But there it is. There's our fundamental accounting equation, also used in finance. But in finance, we think of it like this. This is the use of cash. So when UPS buys the brown trucks, when the manufacturer buys the building to make things, when Google buys the building to put their server computers, those are assets. Excuse me. That's the use of cash. We buy assets because we think we're going to make profit from them. UPS is going to make profit from the trucks because they're delivering. Google is going to make profit from the servers because they're running the all sorts of things, particularly the Google website. That's the use of cash. We invest in assets. But where do we get our funds? The source of cash comes from either debt or equity. So debt is when we borrow. Equity is the owner's part of it. All right. This is how financiers look at it. And this formula, this equation here, use of cash equals source of cash, will be our starting point when we do our cash flow identities. Cash flow. Cash in, cash out. That's what finance people look at. Cash flow does not equal net income. Forget it. Profit and earnings. All sorts of accrued things in there that don't equal cash flow. Therefore, as I mentioned, we're going to have to be able to derive cash flows from information on the balance sheet and income statement. All right, let's go look at our cash flow identities. Next slide, 5. We have cash flow from assets equals cash flow to creditors plus cash flow to stockholders. Cash flow from assets. We buy assets, and we buy assets. Why? Because we want a profit. Cash comes from those assets, and then it can go one of 2 places: from the assets to creditors, or to stockholders. From stockholders. So here's the asset side. Here's the liability and equity side. Now, cash flow from assets. Remember, when you buy assets, UPS is buying the brown truck. Google is buying the buildings and the server computers. Those are assets they buy. Why did they buy them? Because they think they can make a profit from them. They think they can make cash. So we have our cash flow from assets. And any cash flow from assets has to equal the other side, any cash flow to creditors. So if we pay interest or we pay back a loan, that's cash. That's actually cash going to the creditors. Cash flow to stockholders. So if we pay dividends, right? So if there's a big fat positive over here, and we're going to pay some of it out to creditors for interest, some of it out in dividends. Now, this isn't always this one isn't always positive. It could be negative. Think about this. What if you're taking a lot of your cash and reinvesting it, right? So you could go out and buy some more assets, right? Similarly, this cash flow to creditors can be negative if we're borrowing. At the moment we borrow, the creditors are giving the company lots of cash. Same with stockholders. All right, let's elaborate because we have to do calculations to get this number, calculations for this and this. Next slide. Oh, here they all are, color coded. So cash flow from assets. Here's how you calculate that. You got to calculate your operating cash flow. And this really is very important because this is your normal operations, right? Whatever cash flow from that. And then here's where you subtract your net capital spending. Now, capital spending means when you buy new assets, right? So if you have tons of cash coming in from your business because you're doing so good, but you're spending a lot to buy new assets because you're growing your company, right? Then capital expending could be bigger than operating cash flow. Also, remember this is assets. So the cash we're getting from running our business, buying any new assets. Oh, but remember this is long-term or fixed. On the balance sheet we had current assets and long-term or fixed assets. So this just means change in net working capital. Now this could be a plus if you're going out and buying lots of new inventory. So this short-term asset, current assets, these are long-term assets, fixed assets. They're both assets. If these are positive numbers, that means we're subtracting a positive number. It means we're increasing in size, increasing big long-term assets like trucks and buildings, increasing short-term assets like inventory. This one could also spell trouble if your accounts receivable are getting bigger, but you're not collecting them. Nevertheless, in general, these are positive when you're increasing your size. So then that means if we're buying new assets, we of course subtract them from our cash flow from operations. And that will give us our cash flow from assets. All right, operating cash flow, we have to be able to figure out that, and that. So again, we have to calculate these three things. Operating cash. So we're going to take our earnings before, and I'm actually going to go up here and look. Here's the identity, but let's go look at an income statement. Income statement right here. Earnings before interest and tax, right there. So we take that number, and why in the world do we not subtract? Interest is an expense for the business. This interest, remember, that's a cash flow that goes to who? The creditors, the bondholders, the people that gave us the debt. So that doesn't go into operating. That'll go into cash flow to creditors. Taxable income, absolutely we have to subtract that. But wait a second, as we look through all these expenses, remember we talked about depreciation last video? Oh, that's a non-cash. So the formula for cash flow from operations is going to be earnings before interest and tax, which is EBIT, boop, that, plus you add back in your non-cash expense minus your taxes. And there it is. EBIT plus non-cash depreciation minus taxes. Net capital spending. We're simply going to have to look on the balance sheet, and we're going to have 2 years. End minus begin always gives us the change, right? So if your assets are they started out at 100 beginning, and they went up to 150. What's 150 minus 100? 50, and that means you would have increased your assets by 50. But oops, depreciation, just like on the income statement, depreciation is recorded on the balance sheet. That's why net, it's always called net. Let's go look at the balance sheet. This is not an accounting class, but trust me, your assets, as you take depreciation over time, this number goes down. So the net means we've already subtracted out our accumulated depreciation. Well, the problem is whoops, if we're going to calculate net capital spending for the period, begin minus end, we have to add back the non-cash depreciation. So we're always going to look on the balance sheet for the beginning, end, and then on the income statement for depreciation. And that'll tell us our net capital spending. change in net working capital. Change in anything is always end minus begin. So let's go look over here. Here are 2 years, 9, 10. 9, 10. But what is working capital? Working capital for the year 2009, remember that picture we had, the difference between current assets and current liabilities. That's so important because these current assets are cash coming in the short term. Current liabilities are cash going out in the short term. So for 2009, we take current assets minus current liability. That gives us the begin net working capital. We go 1 year later, 2010 current assets. We take that, subtract our current liabilities. That gives us the end net working capital, and then we subtract those two numbers. So really, end net working capital, end current asset minus end current liability. Calculate that, then do a subtraction. On this number you've already calculated because this is begin net working capital. Begin current assets minus begin current liabilities. All right, so now once you have those, you plug them in here, and that gives you cash flow from assets. Cash flow from bondholders and creditors are pretty straightforward. We got to pay interest, right? So that's a cash flow to the creditor. Net new borrowing. We're going to look on the balance sheet and say end long-term debt minus begin long-term debt. Again, we're always looking for the change. So, and this can be positive or negative, right? If debt, long-term debt, LTD, long-term debt goes up, this will be positive. And then we'll say interest paid minus the new debt we issued. And that'll give us the cash flow to creditors. Cash flow to stockholders, similar. Dividends, that's paid out to the stockholders. And then we look on the balance sheet. End common stock and paid in surplus minus begin common stock and paid in surplus. Now, once we calculate those, then we have them all. Now, let's just look at this one more time. It says cash flow from assets, right? That's coming in. The assets are generating lots of cash. So that's a from. Both on this side of the equation are to. So from assets to these two possibilities. All right, now we got to go over to Excel and see if we can do this. Here's our workbook. I'm on the in-class example. Now, this is a big, comprehensive problem we're going to do here. In the problems in the textbook, we're going to be given a bunch of information, right? Name of the country, the company, the dates, the tax rate. And for a bunch of different accounts, we'll be given begin and end. And we're going to have to create an income statement, a balance sheet, and then calculate our cash flows. All right, let's go ahead and see if we can calculate an income statement. Now, since there's so much room to navigate here, we have some numbers here we're going to need to use in our formulas. Some numbers are going to be from the income statement and balance sheet. I have grouped. Watch this. You can go boop. Hey, what did it do? Oh, I've grouped that right there. Group, and you can do a plus or minus. So after we finish the income statement, we want to work just on the balance sheet. You can see we have collapsed this in essence and then uncollapsed. OK, so sales. Well, we're given these numbers down here. Account, that's the sales, and then both of these years. Now, this says for the year ended 2008. So for the income statement, we only need this number right here. So I'm going to say equals this, and then I'm going to hit enter. Cost of goods sold. Again, this is for the whole year 2008 equals this. And then depreciation equals that. Depreciation for 2008. Now we can calculate our EBIT, earnings before interest and tax, equals, and I'm going to go the sales minus the sum of these two. Now you can do a different formula if you want to do equals this minus this minus this. That's OK too. All right, there's EBIT. Interest, oh, well, that's given. Interest, and this is for 2008, right? So 287. Taxable income. Well, now we have our EBIT, which is the earnings, and then we have a new expense. So for the income statement, we have to say earnings before interest and tax and subtract our interest. Now we have taxes, and we're actually going to have to calculate this, right? Taxable income is 314, and we have a 34% rate. Now, normally when we multiply an amount times a rate or percentage or whatever you want for income taxes, we have to round to the dollar. So I'm going to have to show you how to do that with a formula. But first, let's look at the basic calculation. Taxable income times that rate right there. Now that's fine. And actually, in this example, we're not going to have any rounding problem. Oh, we are. Look at that, 76 cents. So we actually have to round to the dollar. Well, what's the rule? The rule is you look. Here's the position. That's 6. That 6 is where we're rounding to. You'll look over here. Is this 5 or greater? If it is, then we add 1 here and leave those zeros. If it's 4 or less, we hack them all off, 0, 0, and just leave it a 6. I don't ever want to have to do that by hand. So here's how you do it. F2. What are we doing here? We're rounding. Well, just like there's a sum function and a average function, there's a round, R-O-U-N-D. Round, open parentheses. And the screen tip is polite. It says, hey, just give me the number. We have a formula. I'm going to click at the end, comma, and the number of digits. Now, in this class, you can just remember 0. The way that's it. That means round to the dollar. If we did 2, what do you think it would be? To the penny, because the integer, I'm going to look at this example here, that's 0. But if we're going to the penny, 1, 2. So that we'd put a 2 there for rounding to the penny. We're not. So we're putting a 0. And we're going to have to do a lot of calculations like this. So you'll just have to get used to using round to the 0. Oh, that is so cool. I don't even have to know the rounding rule, but I do have to know how to do this. All right, net income equals the taxable income minus the taxes. Now, dividends, that number is given. Dividends equals, and we have our dividends for 2008. You know, I just realized the PowerPoint slides and the these Excel files are not the same, but is that a problem? No. We come up here to our assumption. This is a formula input. I change that to 9. And there you go. Everything updates. Whoa, look at that. That's why we put formula inputs in cells and everything else is linked. All right, we have our dividends. But guess what? We did not, the net income can go 2 places, either out for dividends or we can keep it. So addition to retained earnings, those are the earnings we keep over time because we think we want to take that money and invest in new profitable assets. I'm going to say equals this minus this. So 77. We've paid out 130 of it in dividends, 77 retained in earnings. Now I'm going to click this collapse button here, and we're going to try and do our balance sheet. Whoops. I want to zoom into that exact size there. View, zoom to selection. Alt-W-G. All right, so we have down here, we have current assets, net fixed assets, etc. I wish I could make this a little bit, you know what? We don't need these right here. So I'm going to go like that. And now I'm going to do that again. Zoom to selection. All right, that's a little bit better. All right, current assets for 2009. Looks like current assets 2009 right there. That's the begin number. Tab equals, and the current assets for 2010. Net fixed assets. Well, there they are right there for 2009. Actually, this is a relative cell reference. Go this many over and this many down. So when we copy it over, it's going to move. Those dancing ants will move to that one. See? Move just like that, called a relative cell reference. Now total assets equals SUM, open parentheses, and then highlight. Control Enter, and I can copy this over. If I click here and hit F2, I can see sure enough it worked. All right, so just a mini balance sheet. We're really, remember, in finance interested just about the current assets and the net fixed assets. Remember, on the balance sheet, net fixed assets means there's some depreciation in there. So when we do our cash flow identities, we're going to have to subtract that out. Now I'm going to scoot this in a little bit too, just like that. I know that's hanging out there, but when we put something into cell, it won't show up. All right, current liabilities. Now I'm going to click here, current liabilities 910. So I'm going to come over here, current liabilities 910. So I'm clicking there. And copy it over. Here, long-term debt 49. All right, total liabilities. We can figure this out. Now I'm going to highlight both cells and do my keyboard shortcut. Alt equals. Alt equals. No way. That is a terrible mistake. I did Alt equals, but I immediately went and checked F2. Now notice, that's a year, but this formula thinks it's a number. And the reason why it automatically got it is because it's trying to be polite. It's trying to get all the numbers. It doesn't know that that's a year. So one way to fix this is to grab the blue corner and drag down. Be careful of that. So if I now have it correct, I can copy it over. Now this is going to get a little tricky because we don't have all of the information needed. And by the way, this is the way all finance textbooks work. You always have to back into numbers. They're never going to give them all to you. And that's always true with financial analysis. You know, the stuff you want is not always there, and so you have to be able to back into it. Well, what do we know here? Total liabilities, we got that, and we have total assets. So is there a way to calculate total owner's equity? Well, of course, because owner's equity is assets minus liability. So watch this. 9. I'm right here. I'm going to say equals. Give me that 9 total assets minus the 9 total liabilities. Now notice something. That blue one is right there. The green one is right there. When we copy this over, the blue one will move to there. The green one will move to there. So it'll work just fine. And you can see, sure enough, it got the right number there also. Now, so we backed into that. And certainly we can now check to see if this is right. I'm going to say equals total liabilities plus total owner's equity. And then copy it over because it's a relative cell reference. OK, so we got that right. Now, for our cash flow identities, we're going to need to know change in common stock. Well, wait a second. They didn't give me any information about that. But we do have some information over here from our income statement. We knew what the net income was and the dividends, addition to retained earnings. But that's just from these two numbers. Let's go ahead and plug that. I mean, that's just from internally the profit that we plowed back into the company. I'm going to put that number right here. Change in retained earnings. And this is for 10 because the income statement is for the whole year 10. So right there, I'm going to say, but how in the world can I back in to how much new equity the company issued? This means the amounts that the company went out and issued stock and funds came into the firm. Now we can see, we can eye it. And the trick is we have total owner's equity. Oh, beginning, end. Let's just see what the difference is because let's just go ahead and do this. Equals the end minus begin. I told you in class we are going to do the change formula, begin minus end, like every day, many times in this class. 604. Oh, but that's the total amount. And this is the amount of total change in equity that we got from retaining some earnings. So what do? We just have to subtract it. Minus this right here. Okay, so we really had to think carefully and back into these numbers. We knew we had total liabilities, so we went ahead and calculated total owner's equity because assets minus liabilities equals equity. Then we were clever. We remembered, oh, yeah, we did retained earnings over here. And finally, we had to think and say, oh, we do have the actual total change. And if we know the 77, take the difference between these, subtract that 77, and boom, that's the new stock issuances we made. Now, on to our cash flow identities. All right, that was hard enough. Right now, on to cash flow identities. Now, you can do this how you want. If you do enough homework problems, after a while, you could probably just do a formula here and here. But when you're learning how, it really is helpful to actually put the numbers in the cell, make your calculations in the cell here, right? And then from these visual numbers here, where our cash flow identities are, actually make a formula here and calculate it. All right. Cash flow from assets to creditors to stockholders. Oh, and then this one. But these are all calculated. All the color ones are calculated. So let's just start with cash flow from operations. EBIT, depreciation, and taxes. Now I'm going to come over here and hit the minus here because we don't need the balance sheet for this one. And then I'm going to hit my scroll. So what is EBIT? Equals, well, we got that right there, EBIT. I'm going to hit tab, tab. Tab, tab. Depreciation. This was earnings, but why are we adding depreciation? Non-cash. Tab, tab. And taxes, of course, that's a cash going out. I'm sorry that we have to take into account that. Equals, and then where is that taxes? Oh, yeah, we calculated that using the round, right? Okay. This formula right here could be, we could easily have done this calculation there. But again, when you're first learning how to do this, we're doing a lot of calculation to come up with 3 numbers basically, right? So very helpful to have it explicitly listed here. Now we can just make our formula. That EBIT plus non-cash expense minus, oh man, the taxes. Whoa, it's positive. That's pretty good. We like that. Now, we've got to do our next step. All right, so we have our number here. Actually, we could go like this. Cash flow from assets, we have that first number equals this. And then enter or whatever you want. Now, that's not the total story of cash flow from assets. As a manager, we're happy that the operations are generating lots of cash. All right, net capital spending. Well, we have to find we have to do balance sheet now, right? Actually, end net fixed assets, begin, and then add back the non-cash depreciation. I love those little plus. By the way, if you ever want to group yourself, you just highlight and data and group. And it will group and it'll add a little plus minus. Totally awesome trick. All right, now let's come over here. Okay, end net fixed assets. Well, here's the net fixed assets, 910. So the end number is that. So I'm going to say equals, and that one. Tab, tab, begin. That's the 2009. So equal, and now I can't see the number, right? So I'm going to have to use my scroll. Net fixed assets, that's the begin. I'm going to click there. Now notice we can see the formula here, but we can't see it over here. But if I hit tab, it jumps the screen back over. Now depreciation. Now I'm going to do something efficient here. I could go equals and scroll all the way over to the income statement. But wait a second, I already have the number here, and that number is linked over there. So I just click right there. Enter. Okay, so let's just eye this. End is bigger than begin. So that means we increased our assets. In general, that's a good sign. If the managers are good managers and paying attention, then they see an opportunity to expand their business. They think they have a good opportunity. So that's a good sign. And we're going to have to add that non-cash expense back in. So equals and minus begin plus that depreciation. Wow. So already this is bigger than this. So our capital spending already completely consumes all of our cash flow from operations. Now this happens generally when businesses are first starting, right? You're expanding rapidly, or you are you have some good ideas. You're buying new assets, or you're taking over companies. That, in essence, is also you have a good idea. You see a company, you think it's worth buying, you buy it. So, in general, a plus means you have some good ideas. A minus here, we actually talked about this last video. A minus could mean trouble. If you're selling long-term assets, that probably is not a good sign. However, sometimes companies restructure, right, to become more competitive. So in that case, it could be good if this went down. All right, now we have to, this is long-term asset, short-term assets, which is net working capital. Net working capital is always current assets minus current liabilities. But we have end and begin. All right, we're going to have to make a calculation here. I'm going to just scroll over here and see if we can. Nope, we can't fit it all on the screen. But we could. No, we can't fit it all on the screen. All right, there's our current assets. Oh, yes, we can. There it is. We have end, begin. But remember, current assets minus current liabilities, end minus begin. So right here, this is the end number. So I'm going to have to do 2010 numbers. All of the current assets minus all of the current liabilities. All right. So that's our end. Now I have to do our begin. Equals, and I'm going to go over it. These are 2009 numbers. So there's our current assets. Boop, and you can see it up there. Minus, you can see it up there, and then you click on 2009 current liabilities. It looks like in both cases we're in pretty good shape. Our current assets are almost twice as big as our current liabilities. I'm going to hit tab. Remember the formula, we can see it up there. It's off the screen here, but if I hit tab, it jumps back in view. So there it is. We had our beginning net working capital, and our net working capital went up a little bit. Remember, this is the capital we have in the short term to use to run our business. All right, so now we subtract. The change is always end minus begin. So end minus begin. OK, so it went up. So comparing all of these, right, when we add, this is short-term assets. Long-term assets are fixed and working capital. Add these together, and it's way more, right? So hopefully the business is investing in assets because they think they have a good idea, and they're probably increasing inventory or other short-term assets. All right, now we can calculate our cash flow from assets. Here, up here, I'm going to say equals, just so I explicitly show it out here. Tab, tab, equals our change in net working capital. Now we can calculate our cash flow from assets. Equals operation cash flow minus, and again, this happens to be positive, but it could be negative. So minus that positive number minus this positive number. These are the amounts we spent on assets, buying new assets. So negative. Is that bad or good? Well, of course, you use all these numbers to investigate further. You then you assume, right now we see this, you assume that they have some good idea, but they could be completely bunglers and have no idea what they're doing. They're just buying haphazardly. But hopefully in a big corporation, those managers would be not around very long. OK, so there we have it, negative. In this case, probably good. The buying of assets is greater than our cash flow. Nothing to worry about too much. Now, interest and new borrowing. Let's do our interest. That comes from where? The income statement. So I'm going to scroll over. right there, interest. And I'm going to hit Tab to jump the screen back in. I love that. Net new borrowing. Now this comes from, this is long term. Remember, any short term liabilities were in our net working capital. Net new borrowing. This is the difference between long-term debt. So equals, and we go end minus begin. Notice we've done that end minus begin a lot. Now we can, so what happened? Long-term debt, up. Oh, so we went out and got some more debt. Well, I mean, sort of that makes sense. Somehow, if cash flow from assets is negative, then we better get something from creditors, stockholders, either one or both. All right, so let's do our calculation. Equals interest. That's the 2. Remember, this is always cash flow to creditors. We paid them minus any net new borrowing. This is the amount that came in. This went from the firm out to creditors. This came from the creditors in. 200. Well, that's a positive. All right, well, let's see. So now we have to calculate this. Now, dividends. Oh, we do have net new equity. That's the amount. This is net new equity that actually came in from paid in common stock, not this amount right here. So net new equity, we could simply say equals this. And then the dividends. Oh, this is the amount we paid out. Notice this went up. So this is cash from the shareholders into the business. This is cash going out. So I'm going to go over. And it's listed not on the income statement. It may be listed below, but is not part of the calculation for net income. Notice how it's below. Dividends are not an operating expense. But we have it listed at the bottom there because we wanted to calculate addition to retained earnings. All right, now let's do our calculation. This minus this. You can already see this is going to be a huge negative number because 130 minus our net new equity. Now, 397. We can already eye it and say, oh, that probably makes sense. But now we need to check it up here and make sure that we get, we're like triple checking. So I'm going to say equals that, tab, tab, equals that. And up here, I'm going to say cash flow from assets better equal plus this, these two. So equals that plus this. And I got my fingers crossed. Oh, excellent. They match. So cash flow from assets. All right, that's the technical part of how to do that. And we talked a little bit about what the implications could be for each one of these numbers, negative or positive. In general, by looking at the numbers, you oftentimes can't really figure out what's really going on. These numbers are numbers you calculate to then tee you off to investigate further. All right, that's the cash flow example. We did income statement, balance sheet, and talked about our cash flow identities at the beginning, and then did our calculations. All right, now a few more topics in next video. See you next video.